Good morning, everyone. Thank you for joining us today. I'm Porter Fraker, Managing Director here at Boosted AI. It's my pleasure to introduce Bob Sloan, founder and managing partner of S3 Partners, and Josh Pantone, CEO and co-founder of Boosted AI, for a fireside chat to discuss global markets, machine learning, alternative data, and how to utilize the latter two to mitigate risk. Prior to co-founding Boosted AI, Mr. Pantone was a principal machine learning engineer at Bloomberg LP for 4 years, where he led critical ML initiatives for the terminal and built out several machine learning teams. Prior to Bloomberg, as a student at University of Waterloo, Josh co-founded his first company, Maluva, a deep learning and natural language processing platform that he helped grow and later sell to Microsoft Research. Prior to founding S3, Mr. Sloan was the managing director and the global head of prime services, equity finance, and Delta One products at Credit Suisse. He's also the author of Don't Blame the Shorts, which was named one of the best business books of the year by both Bloomberg and The Economist. If you haven't read it, I highly recommend it. Josh, Bob, thank you both so much for being here today. We're super excited about the partnership with S3 and Boosted AI as we launch our new custom Hedge Baskets solution today. S3 Partners is the preeminent platform for real-time market sentiment, including financing rates, short interest, and float data. Boosted AI is the market-leading platform for easily incorporating machine learning into the process, investment process, to augment signal generation, portfolio construction, risk management, all with explainable AI. And with our partnership in mind, today's focus will be around how investment managers can utilize machine learning platforms like Boosted AI and alternative data platforms like S3's to analyze and mitigate risk, and more specifically on how combining the two makes our smart hedging solution so powerful. We'll also discuss current trends in capital markets, what lies ahead for investment managers. We'll end with a brief demo of the new hedging solution and open up for some Q&A. And guys, I'd like to open up the conversation around social media and meme stocks. It's top of mind for everyone. With social media having more influence on the markets than ever, how can data from S3 help investment managers surface risk earlier? And how can a tool like Boosted Insights use this data to help predict better outcomes?
Porter, thanks for that great introduction, and thanks for the book plug. Always appreciate that. But more importantly, meme stocks were forgotten in the first half of the year because people started making money on their short positions. And the problems of the marketplace have transferred from the short side of everybody's book to the long side. Lo and behold, when you're in a bear market rally, all of a sudden meme stocks are actually a risk for everyone. And it just doesn't go away when the markets are running in your favor. The risk is always lurking out there. So we actually posted about the meme stocks about a month and a half ago. And we said, the factors are still there to make these stocks incredibly squeezable. There will be capital market events that are going to drive activity. People are still losing money, and the dynamics of the financing and float are such that make it easily volatile. And lo and behold, here we are, that's happened. So I think the main theme for meme stocks is we're all flying blind unless you're using data like ours combined with analytics and tools that Boosted AI provide, because the old models like Bara just can't see. You wouldn't fly today without some kind of GPS. You would not fly in a plane that has an altimeter and feel great. It might get you there, but odds are you wouldn't feel great about it. And that's what's happening today. There's been a digital revolution, obviously, but it's the blind spots. Are you flying blind in your portfolio, both on the long and short side? And what analytics are out there to help you see those blind spots so you understand sentiment, you understand concentration, you understand herd risk, and how that's affecting your portfolio? that's the main theme. And that's why people use our data. And that's why they use your service.
Yeah, 100% agree with everything that you just said. I'd say one of the sort of big trends we've seen over the past few years is there's just been a lot more of these black swan events. A lot of things that sort of seem to have come out from the blue, whether it was stuff like COVID or meme stocks or other sort of geopolitical events. There's a lot of these really non-standard risks that have been hitting a lot of portfolios. And I think to your point, a really big thing is finding out ways to capture that. Number one is certainly diversification and making sure that you're doing a good job of some of the historic factors, but how can you start thinking about meme stocks as a risk factor? How can you start thinking about COVID as a risk factor? And for us, a really big part of that answer is really trying to do these sort of semantic analysis and really trying to understand at a back level, what are the main sort of themes or concepts that are actually driving companies? How can we turn that into a risk factor? And then how can we build a short book that's actually diversified across it? And I think to your point, back in 2019, when we first started building that technology, the demand for that was relatively stale. Over the past 2 years, we've actually seen a fairly large surge in people asking for exactly those type of capabilities.
One of the things that's been driving for us, what's been driving product is redefining those terms that are out there that everyone uses. They surround us. We consume them, but we never question. And one of the things that really confounds people is float. And float, let's just use a real world example. So if you wanted to sell a car to your neighbor that you did not own, let's say you could go to Hertz and rent that car and sell it. And what happens in the real world is that the price of the rental contract fluctuates every day. But Hertz still owns that car, and you sold it to your neighbor. He owns it too. So why isn't that calculation in the float? And it's analytics like that that make BARA and a lot of other risk systems obsolete, because it is exactly the dynamics of who owns what and when. Liquidity, how to measure liquidity as a container that you're operating in. That makes the difference in today's market.
Yeah, I think one of the, sorry, go ahead, Porter.
No, you continue, Josh.
I was gonna say, I think one of the really, really exciting things about sort of combining some of our systems is we have the ability to come in and find stuff like SPG being related to shopping malls, related to social distancing, and using that to find something that's connected to COVID. Or we can come in and we can find companies that are related to work from home, or we can find companies that are maybe going to be affected by different types of Twitter sentiment or sort of meme stock sentiment. But then when you can take that set of information and combine it with things like concentration risk or liquidity, that's where I think you can find these sort of like major areas where, hey, there's this huge semantic effect that's starting to hit the market. And guess what? A ton of people are concentrated in these positions. So there's a massive opportunity for a spike in volatility. And this is maybe something you should be thinking of hedging that you maybe not thinking about today. So I 100% agree with that. I think in sort of combining these different sets of data together and these different systems together, you can start to get a much cleaner picture or a much precise and granular picture of where your risks are and how to sort of approach and direct them than any sort of one piece on its own, or then some of the more historic approach to thinking about risk.
Cool, yeah. And with that in mind, can you share a little bit about how your clients or investors are hedging today, and what roadblocks they're coming across in this new market regime?
So from where we sit, the real problems in the portfolio are on the long side. I'm long, and you can see it. So top down, I think what everybody's realizing is that the world is just shrinking. There's maybe 65,000 securities, but there's probably only 2 or 3 or 4,000 that anyone managing anything of size can really play in. So depending on your style, liquidity is waterfalling through those 2 and 3 and 4,000 stocks in a very interesting way. And so the big platforms are actually in the middle of that container, providing liquidity to people that need it. And understanding how to hedge that is really a key component to return. And we find a lot of clients are grappling with that because they don't necessarily really understand their true concentration risk. And that's what our new products are all about, is to how to help you understand how the market is set up relative to you and what does sentiment mean to you. So where's the herd? And am I part of it, or am I about to get trampled by it? And that's really what people are grappling with. Everyone is.
Yeah. Yeah, I would sort of echo that. And I think, again, big part of why people get interested in our platform in general is because they feel like the way they're thinking about hedging and the way they're shorting today is maybe not up to where they want it to be. I think a big part of for us too is absolutely, I agree that most of the risk right now is on the long side, and it's about making sure that you're building customized baskets or customized hedges that actually make a lot of sense for your style. What are the types of risks that you're willing to make? What are the types of risks that you're not willing to make? Making sure that you're aware of all the risks that exist in your current allocations, and then sort of giving you the tools to hedge against those in a really dynamic and intelligent way. And I'd say that's something that probably a lot of existing systems or existing approaches are maybe don't excel at in the current market.
Excellent. Go ahead, Bob.
Yeah, I'd add also one thing. You know, in markets like these, it challenges your basic assumptions about things. So, you know, if I type in 13F commoditized into Google, you'll see 48 million listings saying that it is. It's not. And what happens is that the search engine actually bounces you off the source material. It actually repels you from the truth that you're seeking. And we have found in our particular area where we started looking at, hey, is that true? Are there things in publicly available data combined with our short interest that make something unique, that gives everyone a map to understand where the liquidity is and how to use it? Turns out there is. So, you know, what I would encourage everyone on the phone is don't accept anything, except for people that actually are thinking that way, because the old tools just don't work in a market like this. You need something new. And there's always this question about democratization. If I use something new, does it get democratized away? And actually, what you're in is an arms race. Everyone on the phone, you all are in an arms race to preserve your own status quo. So you need new tools to keep up. And that's really what this particular moment in time is all about. The lights have gone off. Have you shifted and adopted new strategies to fight for another day?
Cool, thank you. And in terms, you know, with that in mind, you know, thinking on the micro level, you know, what are some, you know, macroeconomic trends that you guys see? You know, when you're talking about this arms race, you know, what do you see 1 year out, 2 year out? What are people going to need to do to keep up?
Josh,
yeah, no. I'll take this one first. Yeah, I think from my seat, you know, so we have a platform really heavily designed on making it easy to integrate machine learning and alternative data into your process. So I obviously see things through that lens quite a bit. But I think one of the things that's really, really interesting is we have seen this sort of explosion in these alternative data sets, right? I mean, it used to be there was maybe a dozen you cared about. Today, there's several thousand. But most of them haven't really matured. You know, if we focus on something specific, like say credit card data, it's just now getting to the point where you have, say, 8-9 years of history that you can use. And what's really interesting from a machine learning standpoint is that you really do need a lot of data and a lot of history before you can start fully weaponizing it. But over the next few years, more and more of these data sets are going to sort of come online and become weaponizable. And I'd say that's what I think gets me most excited is I think technology like this actually has some of the biggest opportunities for sort of getting ahead of your peers in the next few years, because you're going to get these new data sets constantly coming online. There's going to be new source of alpha that machines can actually analyze in a much more systematic way than how they're being used today. And it gives an upside that didn't really exist historically. So for me, it's really about like, what are the new sets of data and technology that are coming out over the next few years? And I see just a tremendous amount of opportunities to weaponize things that haven't really been used historically.
Yeah, I think it's about what's driving return and really understanding at a sector, industry, and cohort level, who's doing what and why. It's never been more important to understand market setup. You have to understand who's providing liquidity and who's taking liquidity. It is one of the biggest determinants of return. And so for where we sit, the data sets we're providing, it's a natural fit for the volatility, the undoubted amount of inflation we're going to see, and the further volatility that we will see coming out, because the mix between private and public markets and how that gets marked is a liquidity suck that is very hard to measure. And so it's all about liquidity driving return.
Makes a ton of sense to me too.
Cool. And you guys were in front of, a ton of clients and different clients. So as you're talking to, say, a portfolio manager versus a trader versus, head of risk management, are they looking at risk differently? And how are your discussions different with these different personas?
Where we sit, clients are always looking to find, fix, and avoid something. So we start every conversation as, what are you trying to find, and what are you trying to fix, and what are you trying to avoid? And that can be really different depending on the persona. We're all trying to find out performance, but where in the tails do you want to play and why? That is what we try to help our clients find to do. That's what we try to help them do. Fixing something, am I concentrated, or do I have a cost problem? And then avoid, avoid is grenade. And meme stock is an example of a grenade. So those are the conversations we're having with folks. What are you trying to find? What are you trying to fix? And what are you trying to avoid? And how can our data set help you do that?
Yeah, very similar. I agree. It's what's your central problem and how can we help you get there? Again, I think for our platform, one of the interesting things is we have a pretty wide variety of different types of users. About 75% tend to be more fundamental, 25% are quant, but some of them are kind of like, $10 million family offices. Some of them are really big banks. Some of them are pure quant. Some of them take more of a fundamental approach. And I think one of the things that's sort of interesting is, from our seat, the way that these different types of groups tend to think about it is a little bit different. If you're dealing with a quant, it's about, all right, here's the historic risk factors. Here's some residual risk factors. How can we think about this in a systematic way? How can we drive it out? If you're dealing with someone from a more fundamental firm, we found a big part of it is actually not just, hey, it turns out you're really exposed to, this work from home basket. It turns out you're really exposed to this reopening risk, or, whatever the underlying portfolio is exposed to, but it's also the sort of story behind why. What's driving it? What sort of key piece of insight or key piece of data did the system find that is suggestive of the particular risk profile that it thinks that you have? So one of the things we've sort of found with different types of personas is that 100% agree, we're trying to fix problems, but the question of how they approach it and how they think about it is a little bit different. And we sort of set things up in a way where if you're more of a fundamental user, you're sort of story driven, you have a particular set of insight that you want to be able to convert into a trade idea or into a risk allocation, we can help with that. But if you're trying to take more of a systematic approach and sort of more of a direct sort of algorithmic approach, we have to think about ways of handling that and sort of incorporate that in the platform too. So yeah, same thing. There's a central problem. How do we address it? But I think what's interesting from our seat is the way that we see different types of clients interact with it is a little bit different.
Cool. And as we think about risk factors, and Bob, you brought up, BARA, traditional style factors, as the world has changed over the last 7 months, which factors are clients bringing up the most, or are there new factors? Which factors are, driving the most questions for you guys?
Well, it's an interesting point. Any factor, the biggest constraint is always on the short side. So we've got about 20 different data points that help people identify which piece of the short side is important to them so they can figure out whether the factor that they're using actually applies and what's the friction costs involved in actually applying that. But more importantly, one of the things that we've looked at over a period of time is there isn't a dedicated short seller fund that's actually survived over time. And the ones that do not have a payment mechanism that resembles a traditional hedge fund. They're getting paid to hedge, and that's how they make their money. So you're starting not only with a constraint, but an upward bias that it makes super hard, even in times like this, to make money on the short side. So it's really understanding the intricacies of how that market hangs together and what are the factors that are driving either cost or liquidity and or volatility. And that's how we help people understand that part of the factor. And there's so many different things that people use, but that's our role in life.
Yeah.
And then eventually, sorry, Josh. And then eventually, we're rolling out a new product, which we call Black Maps, which is about sentiment and market setup and understanding concentration. And you can then Z-score everything in the portfolio. So what's cool to us is that we have nailed the short side in terms of short interest. When you combine that with the other side of the balance sheet, you start to understand exactly how the market is set up. And we're very excited about that product, and that will help people truly understand all the types of factor risks that Josh is talking about.
Yeah, I think from my seat, one of the really interesting things is over the past few years, a lot of traditional risk really hasn't worked fantastically. Like if we jump back to say 2001, 2008, the right move was to get out of momentum and go into value. Well, if you made that trade in 2020, you were selling Zoom and Google and buying like shopping malls and retirement homes. You probably didn't have a fantastic trade. You might think about it in a slightly more sophisticated manner and take some of these more traditional sort of covariance-based approaches that you might see in more traditional quant-based approach. And that had a really big challenge too. Again, jumping into 2020, you had companies like retirement home owners that were heavily correlated with fitness equipment that was heavily correlated with cruise lines. I don't think there's ever been another time period in the history of the stock market where fitness equipment and retirement homes were correlated. And so again, if you were, trying to use some of these more traditional approaches on their own, you probably had a pretty hard time sort of navigating the risks of the past few years. I think what gets really interesting is when you can start coming in and saying things like, well, we know RCL and CCL, these cruise lines have been historically related to Zika. And so that gives a connection to pandemic and that relates to COVID. Or we can say retirement homes are, related to an at-risk demographic and that relates to COVID. And you can start actually taking these sort of semantic sets of information and finding, well, here's a COVID risk basket, or here's a meme stock risk basket. You can start thinking about these risks in a different way. And then what I think the S3 data gets really, really interesting for us is, again, once you've sort of figured out, okay, well, here's the sets of risks that you need to be thinking about, or here's how you model these sets of risks, you really need something like the S3 data to actually be able to execute on that. How do I make sure I'm not going to blow up if the world reopens? How do I actually create a short basket that's relevant to it? But how do I do it in a way where I'm not heavily concentrated, where there's good availability in the shorts that I'm trying to make, and where I'm not paying too much to the interest side? And so again, for us, I think the big thing is just a lot of traditional risk really hasn't worked very well in the past few years. And it's about just thinking about it in a non-standard way, incorporating these things and trying to sort of find a bigger picture that's much more powerful than how people have historically thought about it.
One of the things that we find very, very powerful is where does the marginal selling or buying come from? That really is what you're trying to sell for. And if you start looking at cohort analysis, start mixing and matching short interest versus what's being owned by a cohort, what's underweight by another cohort, you start to understand that you're either onside or offside to liquidity. There's no marginal buyer or seller, or there are. So using our data combined with boosted AI will tell you where the sweet spot is moving in your portfolio, so you can start to understand how to deploy the bets. And that's the biggest thing in this market. Your container is constricted by the amount of securities you can invest in. The styles within the container are providing or taking liquidity. And you need to know where the next marginal buyer is coming from or seller, and where am I on that continuum. And that's what makes our relationship so powerful.
100% agree.
Perfect. And with that in mind, we have our platform, Boosted AI. We have proprietary, machine learning algos, and as we're talking about this here, it's we have this engine, but it's only as good as the oil or the gas that you put into that engine, right? And that's how we think about S3. And for folks on the phone, how are we taking say this new data set that you guys have coming out, Bob, integrate it into a tool like Boosted AI, and make actionable ideas today, and more importantly, how can you backtest those ideas and be confident that what you're seeing on the screen gives you confidence to implement a trade that Boosted is suggesting.
So you want me to sort of take that from our platform side?
Yeah.
And I'd be kind of curious too, Bob, after I talk about this, how you kind of show the efficacy of your data historically. That's actually a really interesting question. From our seat, it's really about creating these extremely accurate sort of simulations. So when we're taking a set of data and we're modeling, say, risk in 2008 or 2009, what we're really doing is we're taking a bunch of historic data. We're looking for things like look-ahead bias, survivorship bias. We're making sure it's statistically significant the way that we're setting it up, and we're just using historical data. So we'll, for 2008, we'll take data from 2000 to 2007. We'll train, learn, and evaluate on that, and then we'll sort of simulate 2008, just the way that we would do it, sort of live. And since we're doing that, and we're also looking for leakage, and we're also looking for survivorship bias and other types of sort of forward-looking problems, the end result tends to be that you get a back test that actually relates really, really closely to how something would do live. And I think one of the sort of interesting things that people encounter when they're using our platform the first time is the simulation won't exactly perfectly match your constraint. Like you might come in and tell the system, I want a beta of 0, and it'll show a beta of 0.05. And the reason is that if you look at sort of other portfolio construction systems, a lot of times they'll just say, well, if I was able to perfectly get your beta down to 0, sort of in sample, this is what it would look like. And we don't really do that. We say, well, if I did my best to predict what a 0 beta portfolio would look like, here's what your actual ex ante, here's what your actual sort of simulated performance would look like. And so you'll see, maybe a beta of like 0.05, or maybe it's a little negative or positive, but it won't be perfect because that's not how, things work in the real life. We really try to build a lot of our platform around simulating a performance that looks really similar to what it would look like in a live environment. So the sort of mantra I like to talk about, it could be hard and maybe frustrating to build a backtest that looks good in our system, but if you do build one, you can have a very high degree of confidence it's going to work well in a live environment. Anyway, I guess, Bob, I'd really be curious, like how do you guys prove out the efficacy of your data? Or how do people think about it when they're first interacting with you? So
the first part is it's pretty easy to compare the efficacy. The value of our data is that we're delivering it daily, and the real number comes out every 3 weeks. So it's pretty easy to compare direction and accuracy because there's a public number in most markets to compare it to. So that's basically explains itself. For the combined long and short in the sentiment product, we can show clients back 25 years that the key assumptions we're making about cohort behavior are correct. It's self-evident. You just need to look in the right place. And so, one of the things that we're learning on our journey is you'd never question float unless you had a daily short interest number. You wouldn't. You would just go to your Bloomberg screen, you go to the SI page, you look at that exchange number, and you would accept that. But now that there's something new, you can start challenging the notion that everything that's around us can be replaced. And it's not that you would challenge the notion, that is the notion. So you start challenging the fact that everything that's around us can be replaced. And it turns out that some key assumptions that folks make about publicly available data is just dead wrong. And so you need short interest to make sure to show how it's dead wrong. And when you combine those things over a long period of time, it's self-evident.
Yeah, I completely agree with what you said about public data being either dead wrong or having problems. I don't think, even from more traditional data providers, I don't think we've ever gotten a data set that was sort of clean and perfect out of the gate. There's always a tremendous amount of effort that you need to get it to the point where it's fully usable.
Customers are not necessarily set up
Yeah.
to take in and clean that data and actually look at it underneath and do the things necessary. You have to have a team of 80, 90 people like we do. And 2/3 of the firm are data scientists and engineers. And then look at it and say, what does it really say? Is it worthless and commoditized? Or if you combine it with other things, is it totally valuable? And what we have found is if you take a lot of experience, a gold standard for one half of the balance sheet, you can make something that looks commoditized into something that is pure gold.
Yeah, I completely agree with that.
And Bob, I guess this one will be directed to you. In terms of, we're talking about hedging today, talking about short interest. So most people think of hedge funds, right? People looking to hedge stuff out, people looking to short stocks. When you introduced me to the Black app 7 years ago, I was an equity salesperson looking for interesting stuff to talk to my clients about on the short side. Have you seen a shift in terms of long-only investors really digging into this data as part of their investment process to look for setups on the long side, as opposed to maybe 2 or 3 years ago?
Yeah, 100%. So what we've seen is that the traditional allocator / mutual fund / index fund is looking at the short side intensely, and for many different reasons. One is just float. It is a daily conversation at most major trading desks on big buy side trading desks. Two, if you're an indexer, how you value the financing intrinsic to your position is everything. And then 3, what type of liquidity am I looking at? And how can I understand short interest as a way to predict capital market activity, whether that's secondary buybacks, et cetera. So there's a lot of different ways in which people use this data to understand what's happening in capital markets.
Yeah, I think a really big thing for us is just the synergistic effects of literally everything Bob just talked about. You can take everything that he just talked about. It's ridiculously powerful on its own. But then when you take that and you combine it and you start thinking about other types of trends, whether they're semantic, whether they're something like a factor rotation, whether it's just a general sort of shift in the regime, and you start sort of combining these different things together, you can get these really interesting insights that can be really, really powerful compared to, again, using some of the more older mechanical systems.
I just have a question coming from the crowd that I think is relevant to this for you, Josh, is, we're talking about hedging as well. We're talking about, creating these baskets. But, the data coming in from S3, can it be used in the signal generation portion and not just for hedging as well?
Yeah, absolutely. Actually, it's one of the really interesting things is we've actually found on the long side that there can actually be some good signal embedded into it. It could be, so kind of like the 3 different ways you can think about it is you can use this set of data within our platform to make sure that you're getting a very good executable hedge basket that you can be confident you'll be able to run in a live environment. The other way, though, is you can use it as signal on the sort of risk side. So, the most obvious one is concentration risk, but, beyond that, things like liquidity risk or, if you've got like very low liquidity, very high interest and a very high borrow cost, and then you combine that with, say, negative sentiment, there may be, some short flow of opportunity examples there, which then sort of leads into the third thing, which is that, believe it or not, this set of data, when combined with other things like sentiment, like credit card data, like earnings data, can actually be a really, really powerful on the long side. And what we sort of found is you get these sort of occasional really big events, like GameStop, to call it one, very particular one, that can have a very powerful effect. They're less frequent, but if you can find those sets of patterns in a systematic way, it can be very, very powerful. So yeah, 100%. A big focus of this talk is on the hedge basket side, but 100% this data is integrated fully into the platform. And if you wanted to use it to actually build out some models for doing long predictions or signal generation, or just risk analysis, that's all stuff you can do.
Perfect. And I guess we're coming up on some time here, Josh. So I think we'll take 5 to 10 minutes for Josh to give you a sneak peek at the new hedging solution that we're launching today, and then we're going to open up for some more Q&A from the audience.
Phenomenal. So I am just going to blast through this really, really fast, and just as a sort of quick. By the way, the screen coming up okay?
Yes.
Phenomenal. And just as a really, really quick sort of background, so we've developed a platform that's trying to make it really easy to incorporate machine learning and alternative data into your process. Again, there's a huge diversity in types of clients, anything from people that are looking to own stocks for a few years, very low turnover, and are just trying to sort of analyze general trends, find buy opportunities for potentially identify torpedoes, to firms that are systematic, that are turning over 3,000 +% a year, to firms that are using our system just to sort of launch ETFs and non-standard products. And so we've got a fairly large set of nuclear capabilities under the hood to analyze things from a lot of really different perspectives. And where I've been really, really excited about working with S3 is we can now take all of those nuclear capabilities and really focus it on just a very core problem of, given a particular stock or a particular portfolio, how do I create a hedge basket that's going to maximize my core objective, ideally something like alpha or upside, while minimizing downside or other risk. And sort of the other key component is, can we build it in a way where it's very customized to my mandate or how I think about the world, or that sort of makes sense and resonates with my particular investment style. So I'm just going to blast through this really quickly in about 2 to 3 minutes. Won't show all the capabilities, but the main thing I sort of want to emphasize in this is that there's a lot of nuclear capabilities and a lot of ability to sort of drill down into it, but it's designed to be very, very easy to use. So it's easy to use, but sort of hard to master. So really, really quickly, you can sort of come in here. You can select a portfolio if you want. You can select a particular stock. You can make this as easy or complicated as you want. You then can basically have the system tell you if you can tell the system there's particular universes you care about, or you can press the skip button if you want, and it will basically automatically figure out on its own. Here's a set of universes that it thinks are particularly relevant. So we put in Tesla, and it came up with the S&P 500, the R1K, and the NASDAQ. But if I'd wanted to, I could also come in here and tell it, I care about a particular sector, or I care about maybe I want to do an ESG hedge, or I want to do a hedge around a particular geography. So we'll come in here, maybe I'll select a few of my own personal universes. Then the system's going to go through. It's going to figure out, what do we want to compare this to? So again, you could come in here and maybe you've got a hedge basket you got from a bank and you want to see how this system compares to the bank recommendation, or maybe you have your own internal set of benchmarks, or maybe in this case it's just a very simple, what's it look like compared to going long Tesla, short the S&P 500. And again, across all of this, if you want to just skip it, you can do that, and the system will figure out automatically on its own what it thinks makes the most sense. And then it's going to basically set up a bunch of different experiments for you. Some of these are going to be more sort of traditional quantitative experiments. Some of these are going to be very deep machine learning experiments that are, trying to look at things like, semantic risk factors, sort of market mosaic of different ideas connected to companies, that'll look at things like signal prediction, that look at macroeconomic trends, and some of these are just going to be more sort of a straight correlation. And then I hit calculate backtest, and voila, it's going to go out and try to find different types of ways of hedging against the underlying position. And then you can actually sort of come in, take a look at what I figured out, what the underlying risk basket is. And I think one of the things that's sort of interesting is, for Tesla as an example, you can see that it's going to have solar companies. You'll see that it's got some auto companies, but you also see that it'll come up with companies that are actually technology companies. So it's able to figure out that for Tesla has some automotive risk associated with it. It has some risk exposed to the sort of solar concept. It has risk, but it also has risk where it's, kind of trading like a more traditional technology company. And so it's able to create this very idiosyncratic, very specialized hedge basket for Tesla itself. I can come in and sort of see, well, how does this compare? How does the hedge basket you came up with compare to what it would look like if I just gone long Tesla and short the S&P 500? So blue is how our basket did. Black is how long Tesla, short the S&P 500 on its own would look like. And you can see that, there's a very comfortable spread. So it's doing its job. And then if I want to actually run this, there's basically an entire system around getting deeper insights, more analysis around what are the actual risks associated with this, some of the standard, bar risks, but also some of the more machine learning driven risks. And there's a whole system around sort of trading and executing. So again, very, very simply, you just come in, give it a portfolio, give it a stock, tell it to hedge, and then you can customize how it thinks about the experiment really heavily, or you can just sort of let the system figure everything out for you and come up with a very specific idiosyncratic set of suggestions. So I guess for that very, very quick sneak peek of the product, let's dive into questions.
Perfect. Thanks, Josh. I guess the first question that came in, kind of an interesting one, just given how common it's becoming for traders to incorporate as much data as possible into their strategies. Do you guys think that the term alt data is becoming outdated?
It's a really great comment, actually. So one of the things that I was thinking about, and Josh, congratulations on everything you all have achieved. Let's talk about utilization, because heretofore that was the only thing available that actually meant something in the world of trying to measure short interest as it relates to factor risk. And if you think about it, folks treat utilization like it's a consolidated tape, like it's a perfect mechanism. And when you understand how it's constructed, let me get this straight. I give what I want, but I hold what's most valuable back. And then we, in the hopes of taking all these things that nobody wants and aggregating it together, that becomes this consolidated tape of total accuracy. And to me, that sounds like a CDO. I take a bunch of single B unrated tranches, I put them all together, and voila, we have AAA. Well, we kind of know how that works. It falls, and anybody who watches The Big Short knows that when the guy pulls the one domino out from everything else, it falls down. So rate data needs to replace alt data. You need truth, and you need something that can actually measure up to truth so that you can go on and trade in the constraints that you have today.
Yeah, I actually absolutely love this question, because I think I would completely agree with the central premise that if you're not using data that was that didn't exist in, say, 2000, you're probably a little bit behind the curve at this point. And so I think from that standpoint, I would completely agree that to some degree the term alternative data is a little bit out of date. That said, we're still encountering huge parts of the industry that haven't adapted this, that don't have the in-house capabilities to sort of understand, process, and weaponize this data. And then the other sort of comment I'd make is sort of echoing what I talked about earlier. We have looked at or scanned, maybe in the range of a few thousand particular sets of data, or are aware of a few thousand particular sets of data. And of them, the vast majority is still not really in a spot where it can be consumed in a fully systematic way. But the number that are going to be coming online over the next 4 or 5 years is quite high. And so kind of a way that we think about it is, as time goes on, there's going to be more and more of these data sets that are going to be weaponizable, that can be incorporated. And that becomes sort of the new set of alt data. So I agree with the premise to some degree. The term alt data is a little bit outdated because you need to be using these sets of data in some way. And to Bob's point, it needs to be good quality data. It needs to be data that encompasses the truth that you're looking for. But the other comment I'd make is there's going to continue to be new data sets coming online. You need to make sure that you're in a good spot to be consuming and taking advantage of those too. Love the question.
Cool. And second one is, can this methodology be applied at the overall portfolio level for multi-asset portfolio managers?
It can. You know, a big part of our focus is on the security side, and you know, particularly dealing with stocks. But we can actually deal with things at a more macro level. One of the things we do that's actually kind of cool and interesting is we'll take a lot of these sort of micro learnings that we'll have at a stock level, and we'll bubble them up into things that can be done at more of a macro level, whether it's across sector or across allocation type. And you know, the way that we'll sort of tackle something like fixed income is at more of a macro level. How are things moving? Are there ETFs that we can find that can sort of model this, and how can we make predictions about it? We don't dabble in you know, fixed income purely, so we don't do things like corporate bonds, but we can sort of analyze at a very high level. If you've got some mix of things that are some fixed income, maybe you're trying to do some FX, so you're trying to do some stuff related to, you know, stocks, and you're asking the question, well, how allocated fixed income versus stock should I be, or this region versus that region? Those are some questions that we can answer at a more macro level. We just don't do non-stocks at a sort of more micro level. And actually, I'm not really sure for Bob. I'll let you take that one.
So our view is we've got two new products. One we spoke about. We also have a credit product coming out. And one of the things that we see is, you know, who knows more, the credit committee or the short sentiment? And you start combining that with all the other data sets we spoke about. It's pretty interesting to see a creditor's view on the world versus an equity long short manager and or hedger's view on the world, and see how that applies to risk. It's pretty fascinating, actually, because one definitely trails the other. We'll leave it at that.
It's really interesting.
Yes, back in 06, 07, when I was at B of A, you know, all the veterans said, you know, when the credit analysts start hitting CNBC, that's when you know trouble is around the corner. Cool. So next question here is, how should one determine the optimal time to recalibrate or rebalance a hedge basket or portfolio?
Yeah, that's a really interesting question too. You know, I think one of the interesting things from our standpoint is that the underlying machine learning is designed to be very dynamic. It does things in a sort of cross-sectional way, so it's comparing every stock to every other stock. And the sort of end result of that is it tends to get these very idiosyncratic views. And also because we're able to sort of supplement things like, you know, traditional covariance with things like these semantic risk factors and stuff that you can start getting from news and other sets of potential information, it has some ability to sort of switch and change and understand regime shifts. And so from our standpoint, you know, the right time to change depends a little bit on your style. Like, it depends a little bit on how much turnover that you're willing to take, how long your view is, how much risk you're willing to take, and how much risk you're not willing to take. So that's probably the single most important criteria, is what is your mandate and what is it that you're trying to achieve. But once we've sort of taken that into account, the second side of it is, has there been an underlying shift in the underlying assumptions that went into creating this hedge basket? And that's something our system does a really good job of. And you know, one of the sort of interesting things is when you look at some of these sort of semantic risks, you can actually see them change over time. You know, if you go back into 2019, things like vaccines and work from home weren't even really a major risk at all. And if you start looking at some of the portfolios going into late mid 2000, all of a sudden you get like reopening and you get vaccine risk. And you know, you start shifting into 2022, and all of a sudden vaccines go back to being a very small portion of the predicted volatility. And so as you sort of see these shifts or these changes in the types of risks that the system think, and if they change enough from the underlying assumptions that you initially started with, and if you combine that with what your style is, there comes a time where it makes sense to reevaluate the underlying basket and switch it. So it's, you know, it's a little bit more custom. There's not any one unique answer. It depends on the particular client. But in general, it's just about thinking about it in an intelligent way and you know, combining human intelligence with machine intelligence to get what it is you're trying to do. Really curious to hear your answer as well, Bob.
I think you summed it up beautifully. I'm not going to add to that.
Got it.
Cool. Next question, first to Bob. Can you expand on how S3 thinks analytically of the intersection between short interest, float, crowding, and short squeeze risk? And then for Josh, it would be helpful to understand how these factors are going to fit into Boosted's new interface holistically and/or individually.
Excellent. Maybe I'll let Bob start, and then I'll answer from our side.
So the number one thing is, how much are short sellers in or out of the money? Period. If people are making money, they don't cover their bets. When they lose money, volatility increases. That's number one. Two, if you're accurately measuring the float and really understanding short interest as a percentage of float, you know, all these numbers that come out 140%. I mean, it's just, what can be 140% of anything? There's only 100%. So the numbers themselves, if you think about it, are just nonsensical. But when you're measuring float correctly and start to measure short interest on a daily basis, you have a good solid number, well, then you start to understand the supply-demand dynamics, where the short interest of the float of what's tradable actually starts to make sense. So if financing costs are rising, the spot rate and or the book average is rising, your short interest as to the real float, so adding into the second buyer off the short sale, making sure that you're putting that into the calculation. And people are losing money, you're at risk. And that's what our squeeze score does. It actually puts a number on what is something like the Loch Ness Monster. You know, short squeeze is, I think I've seen it, it's mythical, but I really can't really define what the hell it is. So we've actually done that and do it every day in your workflow so that you can use it either as a sole indicator of whether to enter or exit, or combine it with other things, depending on what type of risk you're trying to achieve.
Yeah. From our standpoint, we really think about it in sort of two different ways. On the one side, you can think about it as just its own sort of risk factor, right? I want to make sure I don't have too much concentration risk. I want to make sure that on the short side, I'm not too heavily exposed to things that are having low liquidity. And that's certainly one way that you can use it. And then the other side is sort of unleashing the machine on it and letting the machine sort of find trends. And it can find that both on the long side and present within the short side. So, you know, if we start looking at, okay, machine's going to get access to liquidity data, the machine's going to get access to, you know, border data, concentration, et cetera. And then we combine that with other data sets, you know, maybe things like momentum, maybe things like, you know, historic change in earnings, analyst expectations, analyst spread, market moving news, you know, et cetera. And then, you know, what we'll find is the machine will actually find these sort of patterns underneath the hood, right? So it might find opportunities where, well, maybe there's going to be a short squeeze here, or, you know, maybe there's this interesting difference between how bears and bulls are interacting on this particular stock, or, you know, maybe there's some dislocation. You know, maybe analysts hate this stock, maybe it's heavily shorted, maybe, you know, news sentiment is really negative, but credit card data shows it's going to have one of the best quarters ever, right? And that can tell a really interesting story. So the sort of two ways I think about it is number one, like it's just a direct, straight risk factor that you should absolutely be thinking about, and we can help you mitigate against these risk factors. And then the other way to think about it is giving it to the machine and letting the machine sort of unleash its full ability to find different sets of nuanced and idiosyncratic patterns, and then reporting those patterns back to a user of the platform.
Perfect. Next question is, you distinguish between long and short positions. Would you also factor in increased cash position data as a proxy for a market short position?
Yeah, it's a great question. So The answer is yes. And I think the way that that we look at it is how our typical business. So if you have a container of 1,000 stocks that everybody's playing in, what's the gearing of the folks that are actually providing liquidity? And I think we have enough data to understand what that number is, just like we have enough data to understand internalization so that we actually understand what short interest is. I think if you understand that number, you can understand liquidity, and that factors into sentiment and how you actually look at concentration. So the answer is yes.
Yeah, I would echo everything Bob just said, and probably don't have too much to add on my side.
Cool. I think we have a couple more. Oh, this is to Bob. When are we getting a "Don't Blame the Short" sequel to address post-meme stock era and the new generation of retail traders?
I think my mom asked that question. So you guys for letting my mom, on this call. It's funny. I've actually thought about how to doing that, and I think if you read, there's some really good books out. I mean, Dan McCrum's book on Wirecard is great. There's another book called Pyramid of Lies, which is about Greensill. And so I'll leave it to them to fill in probably what I should have done, but we've been busy building S3. And writing a book is really, 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 really hard work. But I got something else in mind and working on something. So maybe in another year or so, we'll be talking about it.
Perfect. We're running on time here. Thank you guys both so much for joining today. We have 3 more minutes. If you guys have any closing thoughts, happy to open it up to you.
Yeah, I think the one question is alt data. Is that right? It's a really perceptive observation because it's just changed. You have to have data today. And you have to have a team of folks that actually understand how to use that and apply it to the traditional methodologies that you've been using. Otherwise you just have no idea of why things are moving. And the main thing for us is, who's whacking around the float? Because that's what matters. That's what driving stock price. So whatever data you're using to figure out the marginal buyer and seller, that's the name of the game. And that's how I would say, most of our clients look at us and say, help me do that. And in markets like this, where inflation is not going away, where who knows what happens in Europe, you just have so many unknowns with a unwinding of QE, raising rates, inflation, land war in Europe, Taiwan. We go on and on and on about all the risks that's out there. You need to have someone help you fly over a mountain range that's covered in fog. And that's what we do together.
Yeah, 100% echo that. I think the big thing for me is when we first started this, earliest users of some of these sets of data, some of this technology, I think really did have a bit of an alpha advantage. And that continues to be true to some degree, but I think we're very quickly entering a world where it's sort of a high watermark, where this is sets of technology that you really need to be successful. And I think one of the really interesting things for us is, when we first got started, 2019, 2020, we were really starting with customers that were, maybe 1 to 2 billion AUM hedge funds. And where we sort of ended in 2021 is we're starting to get adopted by a number of the very large banks. Some of the biggest institutional players in the world are starting to get really interested in this particular type of technology. And so for me, I really think we're sort of hitting this critical point in the industry where this technology goes from being an interesting novelty to something that you just critically need in your process to sort of navigate the fog in the mountain, to use Bob's wonderful metaphor. Anyway, all that said, thank you guys so very much.
Josh Pantoni, Bob Sloan. Thank you guys so much for joining today. To all the people on the line, thanks for listening in for the hour, and have a great rest of the summer.
Great. Thank you.